We have considered what GDP is and its connection with money. We have also introduced two approaches to analysis of GDP, the Keynesian and monetary approaches. In this segment, we're going to consider the object or purpose of this analysis. In broad terms, the aim of aggregate economic analysis is to explain the business cycle. The term business cycle refers to changes in GDP over relatively brief periods of time, quarters and years rather than decades and centuries. Because nominal GDP is the product of real GDP and the price level, it is useful to look at both. When real GDP is growing, this is referred to as a business cycle expansion. When it is declining, this is a contraction or recession. The Great Depression was a prolonged and deep contraction. The Depression lasted 43 quarters, from the third quarter 1929 to the first quarter 1933. Real GDP fell by 30%. The longest business cycle expansion recorded for the U.S. was 120 quarters, from first quarter 1991 to first quarter 2001. In the 19th century and first half of the 20th, there was deflation, falling price level during contractions. Inflation occurred in some but not all expansions. In the 1970s, however, Americans experienced a new phenomenon, recession and inflation occurring simultaneously. The name given to this phenomenon, which surprised economists, was stagflation. The theories economists were using suggested that the two macroeconomic problems, recession and inflation, would not occur together, but they did. Economists did not understand the business cycle nearly as well as some had thought going into the 1970s. Recovery from the 2007 to 2009 recession was considerably less rapid than the average recovery since World War II. How to explain anemic expansions became a hot topic in macroeconomics. During the administration of President Kennedy, prominent Keynesian economists thought the problem of the business cycle had largely been solved. Macroeconomic knowledge could henceforth be used to fine-tune the economy. Milton Friedman was skeptical, arguing that economists did not have knowledge sufficient to allow fine-tuning. But even Friedman suggested well into the expansion that began in November 2001 that Alan Greenspan, chairman of the Federal Reserve, was successful in fine-tuning. Friedman died before the so-called Great Recession of 2007 began. Were he alive now, he might retract his assessment of Mr. Greenspan's performance and recommit to his former skepticism about the limits of macroeconomic knowledge.